Hello, everybody, and welcome to Stealthily Wealthy. I'm Martin Katz.
And I'm Julian Melling.
You are
Welcome.
indeed. You are indeed. So, Julian, what are we going to talk about today?
Well, I think this is kind of our. We've done a couple of other podcasts under our other kind of relocate brand, if you like, and this is a slightly different one. And this is, I suppose, the first one of the Stealthily Wealthy podcast. And I suppose, it's a an occasional podcast talking about all things wealth. And today we're looking at talking about the UK resident non-dom status, which has been in the news a little bit for the last few
It
weeks.
certainly has, hasn't it?
Yeah, that's it, and I think it'll remain in the news. There's a lot of information floating around about it, and again, it's just probably become quite politicised now.
It's been
And I
around for
think
two for 200 years.
exactly, yeah. I mean, it's amazing, really, and it relies on some very old-fashioned rules around where your father was born and where he was domiciled, and it's been pretty much like that for, like I say, for a couple of 100 years. So it's a
Yeah.
shame, really. It's a bit like trust; everything's being eroded and changed just to
Or
suit.
maybe it's changed rather than eroded. You can look at it in a. We'll try and look at it more
Exactly. So
positively.
yeah, that's
Solutions.
another podcast where we start to argue about that. So yeah, it's changed, but I think the big thing, as we'll discuss today, we're not, and for anybody that views this, the one or two people that might do that are not related to me,
If we're lucky, yeah.
they
Or
I think the
if
thing
they're
is,
unlucky.
yeah, exactly. I think it's just gonna be a very general discussion around this, and the idea is to just plant a few seeds in people's heads and start to think about what people can do for their clients and things like that. Really.
Yeah. But
So yeah.
this sort of series is intended to be, it's a little bit more technical, isn't it, than the relocation ones that we're doing. So there's assumption that the type of people who are watching will know a little bit about sort of wealth planning and offshore stuff.
Yeah, exactly. Yeah, we're looking at people who work in wealth planners in private banks, right through to lawyers that work with family offices, IFAs in the UK, wealth managers, that kind of thing. People who really want
Yeah.
to provide really useful solutions for the clients. And obviously, none of this from our side is advice. It's just ideas
No. No,
that
well,
people
it's
can
yeah, it
use with their
exactly,
clients. That's sort of
exactly.
slip that caveat in there.
Yeah, yeah. So do you think, is it worth us just going over just very quickly what the non-dom regime is, stroke was, and what it did for people?
Yeah. Okay. Yeah. Absolutely. So. And again, a very light touch on this, really. So the non-dom status, basically, your domicile is decided at the moment on where your father's domicile was. So in the UK, if your father was French domiciled and you were born in France, you're quite highly likely in the UK, if you're living in the UK as a resident, to be a non-domiciled person, as in you're not domiciled in the UK, you're domiciled in France.
Yeah.
And with that
This sort
brought
of
there's
assumes you're
some.
going to go back to France at some point, doesn't it? And
Exactly
you
right.
haven't
Yeah. So
chosen to
there's been
remain
lots
in
of
the UK
case
forever.
law and case. The thought is that domiciles always taking non-dom status is a fact that you're here temporarily and you'll leave,
Yeah,
go back to to another country in the future, probably your home country. And the realities of that are quite different to actually what does happen and what people think happens as well. So
yeah,
at the moment, if you can claim you're a non-dom, then you can use
yeah,
what we call the remittance basis, which again, in a very simple way, basically says your offshore income and gains are not taxable in the UK, and if
right,
you they're allowed to grow outside the UK. So if you have a portfolio of investments outside the UK, they can grow free of UK taxation unless you remit some of that money back to the UK, and then you
right.
have all things what we call clean capital, which is money that tax is already paid on and you can bring back into the UK with no further tax. So it is a very complex area. And again, as Mike says, it's probably not eroded. It's changed. It's probably quite right, really. It's changed quite a little bit, and it's going to change again now because the Conservatives have basically, in my view, is probably tried to preempt Labour's policies by announcing some quite substantial changes to the non-dom status. I don't know if you've had a view of those yourself, Martin. I know we were talking about the other day. on
Yeah,
the
I
actual.
have. So that, from what I could read, they've
I'm just handing over
decided
to you because I need a cup of
to
tea. Sorry.
change the sort of tax basis from being turning on your domicile to actually a residence basis. Is that right?
Exactly right, yeah, and that's a huge change because if you think about the statutory residence test when that came in, so for years we all were from all planners and advisors and clients were fumbling around because nobody really knew what you were if you're a UK resident or not. So it wasn't as simple as, well, I'm in the UK for 183 days. Is what's the rule? And then they had the 90-day rule, so people were very cautious about not being in the UK for more than 90 nights rather than 90
Yeah.
days. And then you had the working rule. I'm going to work if you work more than 41 days, and that's a working day of more than 4 hours. And then you've got these 6 tests and or 6 ties, if you like. So the whole statutory residence test came in, and that obviously made it a bit. Well, it's meant to make it more simple, but even then, it's not that simple. And
It's not simple, but at least I guess it does clarify in the sense that there
yeah,
should at
it
least
puts
be
it more on the
certainty over
taxpayers'
whether
side, really.
you're a UK resident.
Yeah, it puts it back to the taxpayer rather than. I think the revenue probably quite liked the fact that people were never quite clear of what their status was. You know what I mean? That was always quite a nice thing on their side, wasn't it? They could pick and choose. Maybe I'm being a bit cynical, but maybe it was more on the revenue side and on the taxpayer. Now there's with this domicile, which again is open to interpretation. It's going to be a bit clearer, but just not as well on the face of it, maybe as advantageous. So there's been a lot of doom and gloom around this. If you look at if you go on LinkedIn and look at the posts from various planners and advisors, even I've spoken to some of my clients, and one of them's definitely said that they were planning just to move to the UK at the moment, and they've said actually we're not going to move for the time being because having 4 years of and I'll come on to why it's 4 years in a minute. The 4 years of remittance basis is just not going to be attractive anymore.
No.
So I can touch on that in a few minutes of what the proposed rules are from each party.
Yeah.
But I mean, Martin, you've worked with a few clients, haven't you? There, here and there. I mean, what's your view on the attraction of the UK for the non-dom status? I think it was quite a driver, but you speak to different people, and it's maybe not as.
It's sort of my view has changed a little bit over time. Maybe I have been influenced to some extent by what the narrative has changed to. I do think it's important that we have people who are movers and shakers come to the UK, people who are wealth creators, and so it's good that they've replaced it with something. But I think there is an argument increasingly that it has looked a little bit unfair to have a situation where the mega rich, you sort of Rishi Sunak's wife type person, is able to enjoy all of the benefits of the UK without actually paying tax on their worldwide income the way that everybody else who lives in the UK has to, unless they're non-doms. So I do kind of get it, but I do think it's really, really important that it is replaced with something that's attractive and allows people who want to come in.
Yeah, I think it's all relative. It's great if everywhere in the world gave up similar opportunities for foreign residents, but they haven't, have they? We know that Italy and Greece, Cyprus, Portugal's just revamping theirs. I know Spain's just got rid of theirs, but I'm sure they'll bring some. These things are obviously quite politically topical as well, and they want to. Let's say every country wants to attract that top layer of money generators. But I think, like I say, you touched on Rishi Sunak's wife there, and I think that's one of the issues in the UK. Everyone thinks non-doms are Russian oligarchs or Rishi Sunak's wife, and the reality is that, in my experience, most of them are French financial services workers, really, or running investment partnerships in London. People from the Indian subcontinent, around the UK, running businesses, that kind of thing. It's not the oligarchs, and these people are wealthy, but they're not ultra wealthy, and that there's a benefit there of why they're doing that. I think the other thing is as well, there's a lot of people moved here in the 80s and 90s using the non-dom rules, and they've stayed. So obviously they're deemed domiciled now because the rules changed in 2017. and the rule went from kind of lifelong basis to a 15 out of 20 basis, if you like. And in knowing quite a lot of clients who did the planning around that time because we deemed domicile, most of them have remained in the UK, and they're just undertaking other planning. And like I say, the be all and end all isn't, a lot of people are quite happy to pay tax. They feel it is like a fair thing to do. So I don't think it's more that, I think if you look at Rishi Sunak's wife as an example, where you have an issue there is that at the moment she might be holding a lot of the family assets because she's not resident in India. She's a non-dom in the UK. So that suddenly means that there's no inheritance tax around those assets. The taxation of those assets is very low or non-existent. And so that's part of a global planning exercise. And that's where these things it's not about particular individuals.
Well, that's true. I mean, wealthy people are going to adjust what they do. Very wealthy people, at least, are going to adjust what they do to still ensure that they don't get caught, at least by inheritance tax, I suppose, aren't they? So that's sort of inevitable. And to that extent, you're right, it will dissuade people, those people, some of them, from coming to the UK. And I know, as you mentioned before, you've got at least a couple of cases where people had made a decision to come to the UK and are now not going to. But, So what are your thoughts on how things are going to look going forward then, planning-wise?
Yeah, well, I think there's two things. I said a few minutes ago before I kind of waffled on and distracted myself. Was it's not all doom and gloom, so I'll come on to that. But yeah, so what's being said now? Conservatives have come out and said basically we're going to move to a 4-year. So you move to the UK for 4 years, and you've got 4 years of what we would see as a remittance basis.
It's better, Julian. It's better than the remittance basis because you can remit everything. You can remit everything,
that's right, yeah. So it's slightly better.
And that's a massive benefit.
Yes. So it makes more sense. At the moment, you've got loads of very wealthy people who can't really bring any money into the UK, which is a bit ridiculous.
So now they can bring it in and spend it.
Yeah, exactly. Yes, in that way. I think that makes a lot more sense. There's obviously the repatriation regime as well at the moment. That's the Conservatives have put forward, which all obviously ties into that. So you've got the 4 years on that, and then you've got the inheritance tax of 10 years as well. So anybody arriving and being resident for 10 years, who's not been resident for 10 years before, will be subject to UK inheritance tax. So they're quite substantial changes from the status quo at the moment is the 15 out of 20 on the remittance basis, which, like you say, people don't remit. I've not met anybody yet with mixed funds who's brought them into the UK because the tax is horrific. I think the repatriation regime...
Just to go back to the inheritance tax thing as well, I think that's going to have a 10-year tail. So,
which again is really off-putting, I think.
So you come to the UK, spend 10 years here, then everything that you own is subject to IHT, unless it's subject to an exemption, like business property relief or something. And then, even no matter what you do, if you come and live somewhere else, you go to Monaco, live in the Isle of Man, whatever, leave the UK, you are subject to IHT for 10 more years, whether you like it or not. And at the moment,
without going into loads of detail. Well, I'd say without going into too much detail, again, it could be interesting because, like I say, I think a lot of the non-doms are French people, basically French residents, French nationals living in the UK. And at the moment, we've got a treaty with France. I think with France, Italy, Pakistan, and India. I think it is, which basically means that there's no. If you move to France and you become resident in France, even if you're British at the moment, inheritance tax falls under the French regime rather than the UK regime. Unless you've got, apart from UK citus assets. So it's quite interesting, the 10-year, because I would like to see how it interacts with the rules around the French take on the domicile and inheritance tax. So French people going back to France, the 10-year tail may be irrelevant unless they do away or change the treaty around the with those 4 countries in particular. So it might become a bit of a non-issue, bearing in mind there's the largest majority or the majority of non-doms are French in my experience. I'm not sure if I'm right on that, but I think I'm pretty certain I'm right on that. So that might be, again, not very well thought through, perhaps, unless they're going to change that or get a new treaty where the IHT, it starts to become like a global effect, like it would with most of the other countries.
Yeah, I mean, it's hard to comment
Labour,
on that without reading the treaty, really.
I know, yeah, and again, yeah, I want to make sure I'm talking the reality, what it is. I won't swear, but the Labour. So obviously, Labour have been planning on doing something for a long time because obviously, the Rishi Sunak's wife was a bit of a gift for them, and the whole Infosys thing and all this was great for them politically. But they've come out and said, so one of the Conservative things is excluded property trusts. So a lot of the people who review this, I say a lot in an optimistic way, will be that. So before April 25, so April next year, people can settle their offshore assets if they're non-dom into an excluded property trust, like a basic offshore discretionary trust, and that will always, under the Conservative regime, will always be outside of inheritance tax, as they are today. So you've got people who've become deemed dom and they've set up an excluded property trust. And that means it's forever protected from inheritance tax. It might be subject to income and gains on an ongoing arising basis, but that's
it will be, won't
planning.
it? Yeah.
Yes, it is. Yeah.
Yeah.
And that's what the Conservatives used to have. For a period we had protected trusts. What Labour have said, so they've said pretty much they seem to be okay with the 4 years, the repatriation. The Conservatives talked about a 50% reduction initially, so to ease people in. Labour have said they won't be doing that. Well, the thing they've said, I think, which is probably more divisive than anything, actually, along with that 10-year tail, is that any trusts after April 25, any excluded property trusts, and again, there's going to be lots of rules and things to consider around this, will be subject to inheritance tax. So the protections on excluded property trusts will fall away.
Yeah,
and
it isn't fair, to be honest, because
well, no, it's quite scary, really, as well.
Well, it feels a bit like retrospective legislation, that, in a way.
Well, it is, because then it makes you wonder about freezer trusts and golden trusts. You remember all those things of pre-96s? I can't remember now, but you'll have like the Duke of Westminster having a panic attack, I think, because we're thinking, hold on a minute, we're going to get suddenly put. Are they going to change that on me? Because politically, again, this is where we could go on about this for hours, or I could. Again, I think there's a bit of, it's an attack on the wealthy and the foreign wealthy. So that's going down a lot with, certain types of voter in the UK, I feel. And I think that,
arguably go down well with the majority of voters in the UK, I'm afraid to say,
Yes, exactly. Right.
Yes, because unfortunately the government has driven the economy into the ground, or
that's it.
And so there's a lot of poor people, and they don't really like very rich people, and I kind of get
no, that's it. I think you're only probably 3 meals away from a revolt, but the so like I say, these things, and again, my view on the Treasury is this isn't like, let's just do that because Labour's doing it. These are all plans that the Treasury are putting forward. Like I say, the Labour Reviews Warwick report, which I think is your old alma mater, and I think they
You're not blaming me for that,
forward. I'm going to blame you for that. Yeah, sorry, but I think this could be their plan. The fact that we're going to do away with EPTs. We're going to start chipping away at these things over the next few years. And then the next thing is, it just starts to become more, all-encompassing on all sorts of planning that can be torn up, really. Anyway, It keeps saying about the doom and gloom.
I know, but I can feel you're building up to some good news now. So I'm sitting here with a great
keep walking past the open windows. Keep walking. Don't jump yet. So so obviously, people are up in. You've got clients panicking, you've got advisors panicking, you've got bankers panicking.
Everyone on LinkedIn panicking.
That's it. Yeah, and I think quite right as well, because there are solutions out there. So obviously, a lot of people know my background. It's the exciting world of life insurance for the last 30 years nearly, and I think there's a few of us in the industry now have managed to bridge the gap. So we've worked with some global families on their planning in the UK, and the last time the rules were changed, we did a lot of work with families transferring their assets into insurance policies, portfolio bonds, offshore bonds. There's private placement life insurance,
Yeah.
and these are based for a lot of people that view this will understand what they are. And they're just like a life insurance wrapper. And
do you think it's
basically,
worth us just explaining what those are just for 30 seconds? Because people
yeah,
often
of course,
assume when
So
you talk
life
about
insurance
insurance,
wrapper,
it's just going to be some sort of a death benefit that's paid out.
exactly. Yeah, that's what most people would think, and it's not that. And you're quite right. So these kind of the life wrappers that we talk about are basically they're kind of a container for assets. So if somebody has £1 million that's being managed by their bank in Luxembourg, they can use those assets, that £1 million worth of assets, to purchase this life insurance wrapper, and the assets are transferred into that life insurance wrapper. That person now owns a life insurance wrapper, the value of which is determined by the underlying value of those assets that are carried on, managed by the bank still, and they on a discretionary basis, and they'll lay down a mandate and an asset risk profile, that kind of thing. But the big legal thing is that before, the client may have owned those assets directly in that account that were being managed. They now own the insurance contract, and the insurance company owns the life insurance, the assets in the life insurance policy.
Okay, well,
it's a very common thing.
Let me just see. Okay, let me just see if I've understood that. So basically, the person pays the money to the insurance company. The insurance
by
company,
way of the assets,
or the basket of assets. The insurance company, in return, issues a contract to the person, and that contract says basically that we'll pay you the amount of those assets plus or minus what the investment gain is. So effectively, the person has exchanged the ownership of the assets for a contractual right with the insurance company over the same assets. And it still technically qualifies as insurance, because even though there might only be a very nominal amount of insurance, it still qualifies as insurance, and therefore the tax is treated differently.
Yeah, it qualifies as insurance because it's sold by an insurance company as far as HMRC is concerned. So that's why. So the great thing about this is that HMRC set down the rules about how the tax. So it's not a grey area or a loophole, and it means that people have a really clear understanding about what they're doing and how it will be taxed in the future. And again, without going into loads of detail, it's very, very hard to retroactively affect the benefit of the insurance contract. So when you bought it, the benefits that you were subject to in terms of taxation and this kind of thing are very hard to reverse by revenue services. And there's been a few that have tried, and they tend to lose in court and have to go back on it. So it's a great way of being very certain about the future of your taxation. Now in the UK,
this arrangement is much more widely available, isn't it? So that you don't. This isn't just for Rishi Sunak's wife. There's people.
Oh God, no.
The bonds that start at what sort of value, like 50,000 or whatever.
Yeah, I think typically nowadays, I mean, a well-advised person in the UK, you're probably looking at. They'll do lots of other things before they come to this solution. It's like the last solution on the list, you know what I mean, in terms of planning. So they've done all sorts of other planning in the UK. But probably around 250,000 would be a starting point. But historically, if you remember, you used to have guys that came around and knocked on your door every Friday, like from the co-op, and people paid £5. It's exactly the same thing. It's exactly the same rules and laws around that. So and you'll have onshore bonds that maybe start at £10,000, things like that. Yeah. So it's a very widely available asset. And
there isn't anyone that's calling this a loophole. This is just something that the government's put in place.
Exactly
and
right.
Been around for ages, and it's effectively standard planning. So it's not aggressive.
And only available really from very large, well-regulated insurance companies. And it's a global thing as well. So lots of countries have them and use them, and in some cases are quite portable as well. Yeah. Because of Brexit and industry consolidation, now really going forward, only the Isle of Man and the Channel Islands and Gibraltar will be able to sell legally compliant solutions into the UK. There's a few coming from Ireland at the moment and Luxembourg, but that will probably be stymied quite soon, I think, because obviously Brexit's happened and those businesses in Ireland and Luxembourg can't really carry on in the face of Brexit. So we'll have to look at having subsidiaries in the Channel Islands and the Isle of Man to operate properly. But the benefit of these insurance wrappers is, and this is for anybody, it's not for non-doms, it's for residents of the UK, be they non-dom or not, is that they have what we call gross roll-up. So there's no immediate income gains on the income tax or capital gains tax on the arising gains in the policies. And when they are taxable, in the UK it's quite peculiar. You've got this 5% rule, so you can withdraw up to 5% of the original value. So if you put on the million, you could take 50,000 a year for 20 years. Okay. And if you don't take it one year, you can put it into the next year. So one year you don't take 50, the next year you can take 100 and things like that. So it allows people access to their capital, if you like. And the whole reason why the UK like these solutions is it allows people to plan for their retirement and take extra income. And also they have the belief that most people that use them will remain in the UK, and when they pass away, they do a full surrender and take their money out of the contract, they'll pay tax on income tax basis. But even then, there's lots of planning around that. Obviously, for non-doms, the fact that they're non-dom probably means they're going to leave the UK and go to a country away from the UK, and their insurance contract will be taxed in that country. So, for example, at the moment, they might move to France, and even with an Isle of Man contract, if it's written properly and the person returns to France, it would still be compliant there. And they would be subject to the taxation in France on the policy. If they move to Dubai, it's my understanding at the moment that would be, and they surrendered their insurance contract, it would be tax free. So there's lots of places, like in Sweden, for example, you could go there and surrender, it would be tax free. So there's lots of benefits in lots of other countries around insurance contracts, and that's why they're attractive to non-doms. Now, the other issue you've got is obviously some of these people say, well, we're going to stay in the UK for quite a while, and we're going to become deemed dom because our children are going to go to school there, and we might have grandchildren, all this kind of thing. There's a lot of the people I've dealt with in the past, they've had children in the UK, they like the UK, and they've ended up staying for a long time, and they're going to start to worry about inheritance tax. And obviously, you've got the traditional insurance, like you said, the death benefit route. Which people might start to use more now to pay for their inheritance tax, so they'll have an insurance policy.
Well, because obviously it's going to be the 10-year rule now, isn't it?
Yeah, exactly, yeah. So
it won't matter whether they're non-dom or not.
Yeah, so they'll work around that. And then also, again, there are some really interesting inheritance tax solutions around around life wrappers, insurance wrappers again. So you've got the very basic discounted gift trust, which works for some clients. You've got flexible reversionary trusts, which I think there's some really exciting solutions there for wealthy families that are looking to leave a legacy and want to undertake some proper planning. I think that, they're just not being used enough at the moment. And this is the whole thing. I think the issue at the minute, there's always been that little bit of a gulf between life assurance and people who are advising global families, really. And I think we've closed the gap a bit over the last few years, but that needs to, I think this now will be a big opportunity for everyone involved in advising these types of clients to provide some really useful solutions for them. Anyway,
I think I can anticipate.
Sorry,
I think I can anticipate why they've avoided those solutions in the past. It's because it's asset-based fee, isn't it? Compared with having a trust or something.
Well, this is the whole
thing. If they're very rich, having asset-based fees are not good, really.
No, and I think that again, I mean, just to touch on that and why that is. Obviously, insurance companies they have so they're valued on their solvency ratio and their rather than EBITDA, it's on their solvency and their own funds and things like this. And an insurance company needs to maintain a high solvency as possible. So you might be looking at 150% kind of minimum. And what that means is they've got a 50% more, if you like, than they need to run that business. And a lot of people say to me, well, the insurance company's going to own my assets now. I've got a contract, but I've got £10 million and I put £10 million and I own this contract. What was if the insurance company goes under? And it's quite a fair question because people will hark back to Equitable Life and things like that. And what people maybe don't realise, Equitable Life, you put money with Equitable Life, your money was going into an Equitable Life fund. So Equitable
Yeah.
Life own that property, they own that company. Whereas the life insurance wrappers we're talking about now, they are wrapping around that basket of assets that client probably already had at Goldman Sachs or Pictet or Lombard Odier or whichever
Yeah.
private bank they're banking with.
Yeah.
And they're still the assets of the insurance company, but it's not, if you like, the management isn't all reliant on the insurance company.
No, I
They're
mean,
not.
in
They're
practice,
delegating that investment management
yeah,
responsibility. Yeah.
in practice, they're
So
more of a custodian, aren't they?
exactly right. Yeah. So the reality of what happens if an insurance company goes under, well, it's very, very unlikely. Touch wood, it's not happened in the Isle of Man for over for 50 years since the industry started. And the reason for that is just really good hands-on regulation with a really good regulator where you can go and work with them and speak with them. And if they felt an insurance company was struggling, they would ask them to put in measures. So you'd have what we call management actions. So they might say, right, you
Yeah.
need to lay off these, your marketing and sales people because you're not going to be doing that anymore. We need to manage the accounts better and the finances of
Yeah.
the business and protect the policyholders. Protecting
Yeah.
policyholders is always paramount for everyone in the business. So that becomes the key factor, and then you just manage. You would look to them what we call the worst case scenario is run off that business. It wouldn't go under. You just minimalise it and run it off.
Okay.
And then
All
people
right. So
still have all the
let me
benefits
just,
of the insurance
Julian,
contract.
let's just go back a little bit to the situation with the non-doms who are not going to be treated as non-doms.
Yeah, sorry, I was kind of you let me wonder
let's
again.
let's
Martin,
say
sorry.
they got trust or something, and then going forward as it stands, they're going to be taxed if they're a settler or whatever. They're going to be taxed on the gains and whatnot as and the income on a rising basis, aren't they?
Well, this is it.
The fact that they so now what they should be able to do, if I'm understanding you right, is they could wrap some of those assets up in an insurance bond, and therefore there wouldn't be any income or gains arising because it would all be protected
Correct.
through the insurance.
Yeah, I mean that is probably the huge thing here. So if we accept that Labour are probably going to win the next election, which I think is very highly probable, so the IHT protections will go. However, and obviously there'll be income and gains tax on those trusts and and obviously the existing trusts from April 25.
Yeah,
because both parties have said that.
yeah.
So, like, you're quite right. Really, what we'll start to see now, hopefully, is people that advise these types of clients will be saying, well, you've got these liquid assets here. Because in the UK, again, not to go into any detail, it can only really be discretionary managed share portfolios, or if a client wants to control funds, you can't put your own real estate in these types of solution.
No.
In the UK, you can in other countries, but not particularly not in the UK. Now, the way that this will probably roll out, if enough people, enough advisors can get behind it and work with their clients and advise them properly, is that they can, like say, their trustees will actually put their assets in. They'll go and buy the insurance wrapper before April 25.
Yeah.
And then after April 25, you're quite right, there'll be no arising income or gains within that trust.
Yeah.
So there'll be nothing taxable on an arising basis. But also, what's interesting, if what's in the trust is clean funds, and depending on how it's set up and how that's been operated, then there's also the opportunity that they can take the 5% in the UK, which is, again, always people don't quite understand how that can happen because,
Right.
that how does that work? Because it's in an offshore trust. It just is what it is. It's deemed to be, even though it's an offshore life assurance wrapper,
Yeah.
it's actually being seen as a UK product and a UK asset in that respect.
Yeah.
So it's quite a weird anomaly. Again, a little bit peculiar, but you can take advantage of the 5% rule for the beneficiaries of that trust, basically. So
And that
again,
sounds
they can take
tremendously
5% per annum.
beneficial to get over.
Yeah.
This is a huge issue for people with offshore trusts. And so, on the face of it, that sounds like a solution that absolutely needs to be examined by sort of relevant.
Yeah, I think
tax
the
advisors.
takeaway from this really is, because I sound like I've waffled off and digressed in various directions. I think the key points, like say, is very much the planning. Really, the things that are going to, I suppose, it's what you've got the emotional part of clients saying, well, I'm not going to move to the UK, or I'm going to leave the UK quite quickly because of these proposed rules. So why? What are you worried about? well, I'm worried about being taxed on a rising basis, or I'm worried about the IHT and the 10-year tail.
Yeah.
So it's, what solutions can work for these families. And let's say in particular, we're talking about life insurance wrappers. You're going to have people that, even with the trust or without the trust, they know that if they can do something before April 25, they're going to avoid, because when you put assets into the insurance wrapper, because you're buying it, it's a disposal. So if you do it after April 25, you're going to have this disposal. But again, that's going to be interesting how that works with the new rules against the repatriation as well. So that's going to be interesting. So there could be some opportunities there. So you'll have people who say, well, I need to do this insurance wrapper before then. And you'll have trustees saying, I need to do this insurance wrapper before then. The other interesting thing is that you can then, even with an existing insurance wrapper, in the future, you might be able to do some inheritance tax planning with that, because, again, under the UK rules, you can gift it to anybody you like, as long as it's not...
Yeah, I was going to ask you about that, actually. Yeah, so, I mean, the key is really to give your assets away before you die, or 7 years before you die, or else to ensure that you've got real insurance, I guess, so that you've got enough payout. If you're relatively young, hopefully you won't die, but you can insure against that risk, I suppose.
Yeah, well, you've got gift into Vivos schemes, without getting into too technical, but you've got insurance contracts which will pay for that gap. And obviously at the moment they're pets and they're set at 7 years. So people, and you've got tapering down on pets as well. So it's a pet is a potentially exempt transfer. So that's where a person who's domiciled in the UK makes a gift to someone, and the inheritance tax reduces. The inheritance tax from that gift doesn't go immediately. You've got a 7-year tail on it basically at the moment.
Yeah.
And so you've got insurances already, products that are set up to deal with that. And I'm sure with these new raft of rules and regulations, which if Labour get in, probably you'll have people that design solutions around that to limit, to mitigate some of the issues around the planning. And the Treasury and the government will have planned around this. This isn't.
I was just going to say,
this is all
Julian,
taken into account. Yeah.
Maybe it's worth just mentioning that we're not actually we're not directly tax advisors, but so we can't.
No,
we don't
we're not advising anybody. Do not under any circumstances take what we're saying as any advice.
No.
You'd be crazy to do that.
Yeah. but I mean, what we can do
you must go and speak to a tax advisor.
What we can do is point people in the direction of the relevant qualified people, whether they are IFAs in terms of arranging an insurance contract.
We can affect introductions.
Or whether they are tax advisors in respect of providing the formal tax advice. But I know your background is working very closely with trustees and family offices, and you making sure that they do get that correct advice from the very best people. I know you've been sort of hanging around the city long enough to know who those people are that they should be speaking to get these things arranged for their clients.
Yeah, absolutely. Yeah, thank you for that. That's very complimentary. But yes, I mean that's key. There's some excellent lawyers and tax advisors and financial advisors, wealth managers out there now that in the UK has changed dramatically in terms of needs-based advice now. I think that's really important.
Well, that's one of the things we're planning to do, isn't it? Is to get some of those up on this podcast and interview.
Yeah, that's it. Yeah, we're looking for guests really. So I've got a few on my hit list. So depends how desperate they are. But, I think that's. I think there's this whole thing around the non-dom rules. I know it's very particular to our industry segment, but I think there's a load of discussion to be had around the politics of it and why it's happening, and the unintended
that's something we like
consequences.
discussing, isn't it, between us?
Yes, we're kind of boring old farts now who like to talk about that, and I think we're probably aligned on lots of things. I suppose there's a few gaps where we probably disagree on a few things, perhaps, but that's healthy.
Yeah, exactly. Although these days, we've all got to follow the narrative, haven't we? I suppose that's kind of what they want us to do, but we will definitely not be doing that. We will be having independent thought and robust discussion amongst ourselves and with others over these things.
Yeah, absolutely. I think that's really important. Actually, it's really, really important because, like I said, like I alluded to earlier, I think this is all a bit. It's we spoke about this before. To me, non-dom is a cost of fairness because it's not very fair, is it? And it, on the face of it, isn't very fair. But then it does really, bring a financial benefit because people might cite the Warwick report and say, well, actually, is that as long as
I'm going to read it. Actually, I haven't even read it.
It's really good, actually, but they've not. To me, I know they haven't taken everything into account because, fully enough, they've not taken life insurance wrappers into account, and I know I've got a rough idea of what the minimum is in those types of solution. They've not taken that into account, so it's not a nonsense, but there's variables I don't think they've taken into account, and to me, and I go on about this a lot, is unintended consequences. How no matter what people think, there'll always be something we didn't think of. It's a bit like with what's happening in Ireland at the moment. On the with people, they've suddenly said 80% of people who are trying to seek residency in Ireland at the moment have come from over the border from Northern Ireland because of the Rwanda policy. So it's like I don't think anybody thought about that. I don't think anybody really thought that was going to happen. So obviously you've got these, and I'm sure with non-dom the rules that are being put forward by Labour, there'll be some awful unintended consequences. The most obvious of which is probably people not coming to the UK, but when they don't come to the UK, they're obviously going somewhere else. So that's the
Where
thing,
else
isn't
can they
it?
go?
It's like a double loss. It's a double loss.
Where else is attractive for them at the moment?
Well, I think if I look at the people I've dealt with in the past, the clients I've dealt with, it's not just about tax. It really isn't. It's about the whole. London in particular is a big draw. It's it's a global city. It's got so much there. Obviously, I used to stay there a lot when I was doing working in that sector, and you really start to understand it. And it's a great place to be, and that's why many of them stayed there when they were non-dom. Once they become deemed dom. And even then, a lot of them weren't doing, because a lot of them were French actually again, and weren't doing the IHT protections because it wouldn't, trust. If they move back to France, the trust isn't going to work. So a lot of them would take a bit of a risk in remaining in the UK. And I suppose there's nowhere else like London, but there's nowhere else like Paris, and there's nowhere else like Milan or Dubai. I think it depends what type of people they are and what they want out of life. But again, obviously now we know you can be very mobile. So. Yeah. That's the thing, isn't it? People can, they can, again, have good lawyers that can tell them where they're going to be resident for how long. Yeah. But I think the scary thing with the IHT proposals is where if you make a mistake and you end up in the UK for a week longer than you should have done, are you going to have a 10-year IHT tail?
Yeah,
you know what I mean?
Mad,
it could be that.
It
could be that dramatic.
Rather inconvenient, to say the least. Yeah.
Yes. Okay. And I think that it's those things that are going to put people off, really. I don't know why I started saying going to, sorry, I should say.
Indeed.
Going to put people off.
Oh, good. Well, I think that was an interesting discussion. Probably we should, we're 45 minutes in, so maybe we should wrap this up before, before the last listener falls asleep. But
I was going to say the cure for insomnia is here, so everyone, we can say what we like now. No one else is listening. This is it.
No, exactly. So
But
anyway,
but you could, like I say, we could go on about this for hours. I think there's so much to it, and the reason why, and what we can do, and the planning, and maybe we can do a couple more shorter ones, 10 or 20 minutes, where we do some, maybe with a guest, so we don't step over the line of advice or anything like that. Where we can look at some of the, we can do maybe a couple of case studies or something like that. That'd be quite interesting.
Case studies are always good.
We think it's interesting. Nobody else probably does.
No.
So that'd be good.
Perfect.
Cool.
Perfect. Excellent.
Thank
well,
you.
Nice to see you. Go back to mowing the grass now and enjoy the rest of your
Sunday afternoon. I haven't even started yet.
Have you not?
I might get a few sheep like you, mate. There we go. I've got the wild goats of Laxey, where they don't venture over this far.
Do they not? My missus loves goats. Actually, I'm sure we'll have to come over and hunt them down at some point.
There's loads of goats. The wild goats have really taken off here at the minute. There's a lot
Really?
of them around, actually.
Where do they
Yeah,
live?
yeah,
Do they
a lot
sort
of
of live up above the wheel, or?
No. So I'm on the same side as the wheel.
Yeah.
Probably about as crow flies a few hundred meters from the wheel, which is like the north side of the village of Laxey. And you've then what we call the never-ending bend.
Right.
That's what it's called, which is a bend in the road that goes from Laxey to the north, and it is truly never-ending.
Yeah.
It's bizarre. And there's a headland there, which is all fields, so it's all farmed land.
Right.
It's not like
Yeah.
a moor or anything like that. And the
No.
farmers just let the goats share with the sheep, basically. And
Okay.
they come down probably as far as where the old chalets were in Laxey, down into the harbour,
All right.
and Menorca Hill, and round to the dune. And it's just that little
Right.
segment there, actually.
how
they
many are
seem
there?
to. I don't know. The other day I was driving, and I probably saw about 40, and they're in 2 or 3 different groups now.
Wow. And they're all wild, are they?
Yeah, they're proper full-on mountain goats. They're long-haired, goats.
Wow.
And they're not
They'll
maintained
have to
by
introduce,
anybody.
I don't know, some pumas or bobcats or something to keep the numbers in check.
Get some wolves. Yeah. Oh, some of the cats around here are quite big, actually, but they've probably tackled them themselves. But yeah, I'm not sure. I'm not sure if they will do some kind of cull, because I'm not sure how. It's just sad, isn't it? They'll start to have illnesses and things like that.
They'll
I think
start
that's
to
the
be a
problem.
nuisance, won't they? I suppose, but
Well, they
on the
are.
other
With
hand,
some people, there is a bit of a thing where some people don't like them because they are on the road, and they also will devour a garden quite rapid as well. So
I bet they
when
do.
we're in COVID lockdown, they start to venture closer and closer, because there was no humans around.
No.
So you'd have people like posting on Facebook on the Laxey Central, like, they've just been through my garden and eaten everything, all my flowers.
Bloody hell. Do you know what? I think we could do a whole nother podcast just on the goats of Laxey.
The Laxey goats, the wild goats of
Wild goats of
Ballarig.
Laxey.
Ballarig.
Yeah. Right.
Yeah.
Right.
We'll
I'm gonna press the stop button in a minute. So shall we say farewell?
Farewell.
Farewell, everybody.
See you later, mate. Thank you very much.
Thanks for listening.
Bye-bye.
Bye.
Bye.